Yeah, so property is familiar. It's a good diversifier. But as you said, what happens if you have a lot of property in a stagnant market? I mean, Adrian, you'll be familiar with this. A client of ours, had a property in the northern suburbs of Johannesburg and sold it after 15 years. He made 300,000 rand. And he had asked us about his CGT, and we had to tell him you don't need to worry about this. So I think that's one of the things. I mean, bricks are brick and mortar is safe, but it's not always, and it's not the only asset that clients should rely on. Adrian, do you want to touch on the growth solves everything bit?
I think growth is really an operative word, right? I mean, how do you view growth? I think to Ray's point, I mean, true growth is what? How do you realize it over what term, what period? I think that's really understanding in terms of, and the specific asset you're investing in. I think when we consider growth, we like to look at it as, I think as a company, we all agree, is consistency. Consistency in growth, and it's not going to go in a straight line, but if you can create a portfolio that's diversified enough, that is consistently delivering over 3 to 5 year investment horizon in line with the client's risk profile and investment horizon, that's key. And managing the expectations. I think growth is like I said, it means something to everyone else. So you've really got to place it and manage, I think, more importantly, clients' expectations. I think the world we live in today is instant gratification. If you think about, you see a friend of yours bought Bitcoin, and it's all these hypotheticals. If I had Bitcoin there or I held it there, then I could have made X. I think people don't truly appreciate the biggest asset, I believe, with investing is time. The more time you give yourself and the more consistent you are doing good things, it will pay off. There's no silver bullet. I think we've realized that being in this game long enough. And I think the world we're living in now, because of the amount of information, people are just fixated on getting the quickest return possible with no risk. And that's impossible. So I think to your point, growth is something that needs to be managed according to each client. And sometimes difficult conversations must be had. You need to manage expectations. So that's key.
And if I could just come in there as well on the growth part. So again, to Adrian's point, I mean, it's quite subjective, but I think if you really delve deeper into what growth looks like, it's got to make sense. So if you've got a portfolio that's giving you 20%, 20% is fantastic. Yes, it's growth. You've moved from 100,000 to 120,000 Rand as 20%. But what are you comparing that 20% to, considering the amount of risk you've taken, as Adrian said? And also if you factor in things like inflation, for example, if maybe the fees that you're paying on whatever investment that you've got, what are you actually netting out of the investment versus the risk that you're taking? So again, it's subjective. It has to be dependent on the client themselves, what they're trying to achieve. If you're targeting a 10% return after inflation and costs, what are the real numbers that you're actually targeting for you to make it look like it's good growth, or for you to say it's good growth? What are you measuring it against? So I think that's also important. I think it's always great when somebody throws or dangles a carrot and say, I can, I'm getting 20% returns on my investment, etc. But what about all these other components that you're not thinking?
What's between the lines?
Exactly.
To Ray's point.
Grow yourself into illiquidity and tax problems.
Exactly.
And then, I know we'll all have a lot to say about this, but local exposure is enough, considering where we are now.
I think Ray knows a lot about this. I think before Ray chimes in, I think it's important to realize we have a very small component on GDP, let alone Ray knows the stats from the JSE being delisting and the process involved with that. While we have some superb companies in SA, the key thing we focus is concentration risk.
Yes.
The JSE top, the concentration from a listing and a weighting, it speaks for itself. But I think also globally, we've got to think of, it's not just about SA, you've got to think, where are the key themes that are really driving the economics in our world today? If you think about technology, we know about AI. Everyone's just throwing this term AI. What is the fundamentals that are driving this growth? Semiconductors, digital infrastructure. These are key points that people might not know about that can provide a portfolio allocation that can really drive it. So I think it's not about just saying what's going on in South Africa. Everyone's got to think globally, because that's how we're operating in a world that is global. We've got access to information. We can get things very easily, and we can make decisions on the back of it. So I think we've got to think not just what's going on from a concentration risk here. We've just got to think globally. There's so much opportunity. Why not blend both of them together.
Yeah.
I mean, our bonds in South Africa have been performing really well since
Yes.
there's been a good uptick in the economy.
Yes.
You know, you don't have to choose one or the other. It all, again, comes down to how do we blend these assets together to create something that's diversified for the client.
Yes. And I think just to add to that, and I think, again, concentration risk is one that comes to mind when you talk about South Africa as an economy. So there's nothing wrong with allocating a portion into the South African market. It just depends what assets you're looking at. You know, again, it just feeds into that conversation around diversification. South Africa is an emerging market. But if you also consider factors like South Africa being only making up less than 1% of the global GDP, you know, again, you're sort of limited in terms of how far you can go in terms of growth. So there's a broader market out there. The world is pretty much your oyster. There's so much in terms of options available globally that obviously you don't want to just limit yourself to South Africa. So there are other areas, if you consider the risk that you're taking with the South African, with our problems and some of the issues we have, you know, why not take an investment that's you're not taking that much risk, but you're getting better returns. You can be patriotic about it, sure. But I think, you know, there's so many options in the market, and South Africa can be a good diversifier. Yes, obviously, you know, with the backing of our commodities and all of that, you know, so which have had a good run over the last, call it a year or so. You know, so it all depends how much allocation you want or weighting you want towards the South Africa. There's nothing wrong, but I think it just depends on what you're actually trying to achieve.
How you balance. Yeah, I think for me that's the one that gets to me the most, that local exposure is enough. If you have your business is in one place, your house is in one place, your investments, all in one currency.
Yes.
It's almost like you don't have a portfolio, you have a postcode. I just think, you know, a lot more clients need to understand the risk just from that. And then you touched on diversification earlier. I think that's very important. Now we've seen, I mean, some of our clients, you know, business owners, founders, when they accumulate wealth quickly, they have a good run of 5 years and their lifestyle becomes that becomes their benchmark, those good 5 years. What are some of the blind spots that tend to emerge that they often miss when that happens?
I mean, I think Ray can obviously further, but I think a lot of the time if you're making money quickly, quicker than you anticipated, you might create a sense of invincibility that this will go on forever and it's sustainable. The problem is, and we always say, I think it's, you know, you got to plan for the worst and hope for the best. I think that's, and I know I don't want to sound cynical, but ultimately you got to say, if something drops tomorrow, my biggest contractor drops tomorrow, or my biggest sort of supplier or something goes wrong, what is that going to really do to my business? And can I sustain? Can I keep my staff? And I think almost to an extent, you got to be, and founders are always optimistic. They're always going to be the guys that are going to go in the room and say, we can do this.
It's chasing the deal.
Yeah, exactly. But you've also got to be on the side of it a little bit more pessimistic to say, if something should happen, what will go wrong? And I think you've got to focus on just as much as that, because to your point, if you start, things go well, you live a good life, you buy a good house, and you sort of build your lifestyle to a certain level, and something drops quickly, do you have something to fall back, or can the business pivot quick enough to say, I can maybe take a 6-month hit and then build myself back again? So you've almost got to look at all these angles and say, you know, am I planned for all these, not only scenario A, B, and C, but D, E, F, you know, and I know it sounds maybe pedantic, but again, it goes back to when you spend so long building something and scaling it and creating something, even if you've built it in a short period, but it's something you're proud of. And surely you don't want to see it fall, you know, just like that, which can affect everything around you. So,
and you're quite right. I think, again, it's more to do with education around, you know, what to do when, yes, there's a windfall or things don't actually go the way you had planned with the business. So I think, you know, planning around those scenarios. I mean, I think it's always good to plan for worst case. To look at, okay, so business doesn't do well. What do I have available if I need to, from a personal point of view? Never mind the business. So these are all things that I think a lot of people don't think about or plan, because I think also as entrepreneurs, we're risk takers, right? You know, for you to even start the business, I mean, that was a big risk, you know. So when you start scaling the business, you're quite happy to say, well, it hasn't worked, I can start again and it's going to work because it worked before. So I think it's more about, again, diversification, you know. So how do you try and get a portion of your wealth away from the business. God forbid something happens with the business negatively. So how do you plan for your family outside of the business? So because there's going to be things from a personal point of view that you need to address as well or plan for. So everything can't just be sort of, centered around the success of the business. If there's success in the business, you have to start thinking about pivoting a little bit as well. Saying, well, yes, the business is doing well, but I need to start thinking from a personal point of view if things don't.
The boring conversations. I think you're alluding to wills, structures,
Correct.
Succession.
Correct.
And I think one of the key blind spots that most business owners, we might even be guilty of it, is that they confuse the speed of earning with the skill at keeping.
Yeah.
So, you make money quickly, but then now you then confuse, okay, that I can use that same muscle to keep it. And no, it's not really, your conviction, your business instincts of chasing that deal, of closing that deal is not the same as having, like you alluded to, the boring conversations about how did we structure the business, succession planning, etc. And I think those are really important points that business owners need to be cognizant of when they're building their business. And then let's talk about, once these structures are in place, the founders have shifted and they've now, they've shifted from earning money, the accumulation phase, and then now maybe in their latter years, some of our older clients, they're more in the stewardship phase. What does that look like for their family and for their generations and legacy? What does that look like for some of your clients?
Yeah, I think just from those that I've come across, in that sort of scenario, I think again there's no planning in place. The unfortunate part is there's no succession plan in place. The kids, they might have kids, but they're not necessarily wanting to be part of the business. They're thinking about other things. They want to be overseas. Even education-wise, kids go overseas, and they don't want to come back to South Africa, for example. So these founders, they do find themselves in that sort of quagmire of, after them, there's nothing that actually succeeds them to continue with the business because there's no one capable of doing it. The upskilling bit, some guys are very handsy with the business, that they don't want to relinquish that power and have somebody else coming in and influencing the business. So training up somebody to get to that sort of skill level they have to make sure that there's continuity. Again, that's sort of lacking just based on the experiences that I've seen with some of the clients that I've come across. But it's just a lack of planning. Guys are not planning adequate enough, because I think guys are just thinking this is just going to go on in perpetuity. I'm going to be around in forever years. And unfortunately, that's,
And we've helped a lot of clients move from that phase, building wealth intentionally, to then thinking about family, legacy. So, Adrian, I'll pose this question to you. What has that looked like for clients? What have you encountered when clients are in that stewardship phase, when they're talking about their families and legacy based on the structure that we've put in place for them?
I think it's a great question. I think if you think about it, we've kind of guided clients from, the last 10, 15 years, and you've kind of seen this sort of emergence of younger kids becoming independent, growing up, to Ray's point, moving abroad. And I think the truth be told, they really haven't had those discussions. And I think maybe for whatever reason, they might maybe slip their mind, or they haven't been wanting to have it. I think it goes back to my original point. I think it's a very emotional discussion. I think if you think about it, people have taken 20, 30, 40 years of their life to build up this wealth. To Ray's point, you've been so focused on maintaining and building to sustain yourself and your family, you haven't thought, okay, well, I'm very well off. Now what do I do? And there's this whole dilemma that I think comes in with it, is that how much do I want to give to my kids? How do I want to strike? I think a big conversation that we've come across, and I think we've seen, Kenny, is that people are also looking for their grandkids, to create that system. And it's not about giving their grandkids, it's more about from schooling. We know the cost of education in South Africa is sky high, amongst other things. So I think it's a very emotional discussion, and I think we encourage clients. We always say to them, as you've taken your life to build this, and you can put great structures and things back, but if you haven't communicated it to anyone and you haven't told them about what you've done, it becomes irrelevant.
Yeah.
because all they know is that God forbid something happens tomorrow. Who do they speak to? What does the will say? And I think that avoids something that a lot of people are going and focusing now, even with family offices, is conflict resolution.
Yeah.
You know, all these things that you haven't spoken to about with your kids or grandkids, or maybe you remarried, a blended family as they call it, becomes very difficult, because if you don't have those discussions, I mean, we've had a lot of cases, and
Yeah.
people can also see a lot of cases globally, they become challenged, and it becomes a very awkward, and it literally can tear families apart. So as well as we put all of these great planning and mechanisms in place, if you don't communicate it and you don't tell people, you don't tell them what your intentions are, it kind of becomes an irrelevant fact at the end of the day. So I think that's just as important, and you should regularly have these conversations if things change.
Yeah.
We speak about wills, as simple as it may sound, it's probably one of the most integral documents that comes to planning, because that sets a precedent if something should happen to your overall wealth. So these are small but practical and very important points I think we always encourage clients, as you know, to have at these junctions. So.